Market Top 2026, why the election, crypto, and chips are signaling danger. Welcome back to the channel. Today we are doing a deep dive into something that needs your immediate attention. As your mentor in this market, we have been watching the indicators closely, and the data is telling a very specific story. We are currently navigating a mid-year pivot. This is not just another dip. We are looking at a structural market top that demands a change in strategy. First, let me talk about the AI chip story. For months, the narrative was infinite growth at any cost. Now, the reality is setting in as hyperscalers become much pickier with their capital. We are not seeing the end of the AI buildout, but we are seeing the end of the hype phase. Major cloud providers are now focusing heavily on ROI, and they are pulling back on projects that cannot prove immediate revenue. This is causing an inventory glut and forcing a transition toward margin compression for the hardware giants. While the hype-driven AI giants face a reckoning, savvy capital is already rotating into smaller value-oriented players that have been ignored for 2 years. Next, let's have a look at the crypto market. Bitcoin is under heavy pressure, and the catalyst is regulatory frustration. The market expected the Clarity Act to be a clean green light for institutional adoption, but it's fading fast in Congress now. What I'm seeing now is a painful and slow implementation of rules that are stripping away the Wild West era of digital assets. When you combine that regulatory tightening with a massive liquidation cascade of over $500 million, you get a market that has lost its foundation. Crypto is once again trading as a pure risk asset in a high interest rate environment. With no crypto law passed, there is no clarity. Not a funny joke, right? Then there is the political cycle. We are in a midterm election year, which is notoriously uncomfortable by design. The market is being driven by headline risk from USMCA trade negotiations and tariff threats. Historically, midterm years are the weakest part of the presidential cycle. When you combine that historical weakness with a tech sector that is cooling off, institutional money tends to look for the exit. They are prioritizing capital preservation over speculative growth. So what does this mean for you and your portfolio? If you are an average investor, it is time to reassess your risk. I am advising a shift away from high beta AI momentum stocks and toward companies with proven non-speculative cash flow. You also need to watch the upcoming IPO calendar very closely. There are some massive names preparing to list, but do not fall for the AI premium trap. The gap between private and public valuations is wide, and in this cooling market, those IPOs could become a trap for retail investors. The bull market is showing clear signs of exhaustion. Our final advice to you today is simple: keep your cash dry. Volatility is the new baseline, and catching a falling knife in the tech or crypto sectors is not a strategy. I want to hear from you. I have gone to cash now, have you? Are you rotating your portfolio into value assets, or are you still trying to bet on the next AI breakout? Welcome to Market Cycles Investments. Smash that like button, share, comment, and subscribe. Stay informed. Disclosure: this is for educational purposes only. Past performance is not indicative of future results.